Imagine it's November 1923 and you're standing inside a small bakery in Berlin. Behind the counter, the chalkboard doesn't say 2 marks or 200. It says 200 billion marks for one loaf of bread. The person in front of you isn't carrying a wallet. They're pushing a wheelbarrow, not for groceries, for cash. And as you wait your turn, something happens that feels almost impossible. The price changes while you're still in line. The baker wipes the board and writes a new number, 250 billion. In the time it took you to stand there, the currency lost a huge chunk of its buying power. That isn't a made-up dystopia. That was the Weimar Republic. And variations of the same story have shown up many times since. In Zimbabwe during 2008, prices ballooned so quickly that people needed banknotes with absurd numbers just to cover basic costs. In Venezuela, inflation distorted everyday life to the point where ordinary items could cost millions in local currency. In Lebanon, the exchange rate and purchasing power shifted so dramatically over a few years that salaries and savings were effectively rewritten in real time. Here's the practical question, not the dramatic one. When a monetary system stops behaving normally, when exchange rates and purchasing power swing fast, what actually holds value? Because this isn't about being fascinated by history, it's about understanding what tends to happen in crises so you can think more clearly about risk. I went through a long list of past breakdowns, Germany, Zimbabwe, Venezuela, Lebanon, and pulled out what the financial autopsies have in common. Not theory, not vibes, just repeated patterns. By the end of this video, you'll know 5 categories of assets that historically held up better than most people expect, and which things often went to zero, or close to it, when confidence cracked and the rules changed. Before we get to the assets, it helps to understand the typical arc of a currency crisis. Every country has its own story, but the mechanics rhyme. First, governments run persistent fiscal gaps, spending more than they bring in through taxes and revenue. Second, those gaps get financed in ways that can expand the money supply, especially when borrowing becomes harder or more expensive. Third, purchasing power starts sliding, sometimes slowly, sometimes suddenly. Fourth, households and businesses begin looking for escape valves, alternatives that feel more stable or more scarce. Fifth, if confidence breaks completely, you see a full-blown crisis, rapid devaluation, disorderly pricing, and a scramble for anything perceived as safer. In Weimar Germany, the exchange rate went from already bad levels in 1922 to effectively unimaginable levels by late 1923. In other crises, the time frame is longer, but the end result can look similar. Savings measured in local currency lose real value, wages lag behind prices, and people stop using the currency for anything that matters. So, what tends to survive? 1. Precious metals, gold and silver. This is the obvious one, and yet many people still underestimate why it shows up in almost every crisis story. Gold and silver are not magical. They don't create productivity, they don't produce income, but they have one key feature. They can't be printed at will. In hyperinflation episodes, holding the collapsing currency often meant a near total loss of purchasing power. But holding gold historically did something very different. It tended to preserve the ability to buy real goods across the transition. The unit of account changed, but the metal didn't depend on the credibility of the local printing press. You see the same logic repeated across time and geography. When a government expands the supply of money dramatically, each unit of that money generally buys less. Gold supply does not expand that way, so relative to the currency, it can rise, sometimes sharply. People often critique gold by saying it doesn't do anything. And that's the point. In certain environments, the job isn't to do something. The job is to not be diluted. Even outside classic hyperinflation, precious metals have tended to behave like a form of monetary insurance in periods of monetary stress. During the 2008 crisis, gold initially fell when liquidity froze, because in panics, people sell what they can. But after policy responses kicked in and fear about currency purchasing power grew, gold performed strongly in the following years. Silver, being more volatile, has at times moved even more aggressively, both down and up. Look at the 1970s as well. Gold had periods of sharp drawdowns, then surged later in the decade as inflation pressures became clearer. The lesson isn't gold only goes up. The lesson is that in repeated historical episodes, gold often functioned as insurance against extreme monetary outcomes, not as a short-term trade. So if there's one clear takeaway from a century of crisis case studies, it's this. Precious metals have repeatedly acted as a purchasing power stabilizer when currencies don't. 2. Stable foreign currencies. If precious metals are one kind of escape valve, foreign hard currencies are another, especially in places where the local money is rapidly losing credibility. Picture Beirut in late 2019. You're a worker who saved diligently for years. The local currency had been pegged for decades, and people treated that peg like a permanent fact of life. Then the system cracked. A black market exchange rate appeared, and the gap widened. Over time, the official rate and the street reality drifted so far apart that people learned the painful difference between what your account says and what your money can actually buy. In those environments, people who held their savings in a more stable foreign currency, often in physical cash or in accounts they could access, sometimes preserved far more purchasing power than people who kept everything in the domestic unit. It's not because any single foreign currency is perfect. It's because in a local collapse, the biggest risk is being trapped in the failing unit of account, while prices reset around you. That's why, in many crisis countries, you see informal or partial dollarization, even before governments admit it. People start pricing durable goods in dollars. Rent gets negotiated in dollars. Large purchases shift into dollars. Even where local currency remains legal tender, real life moves to a currency people trust more. You can see versions of this across history. Zimbabwe functionally used dollars in transactions during its breakdown. Ecuador officially dollarized after a crisis. Panama has used the dollar for more than a century. Venezuela today often prices major purchases in dollars, even while the local currency continues to exist. This isn't ideology. It's a survival mechanism. When domestic money fails, people don't wait for permission to adapt. They switch to what works. So the lesson is straightforward. Access to a stable foreign currency during a domestic crisis can be a powerful form of protection. In some cases, it's the difference between losing most of your real savings and maintaining much of it. 3. Productive equities, ownership in real businesses. This one surprises people because it sounds backwards at first. How can stocks do well when an economy is falling apart? But that question confuses nominal prices with real value. A stock isn't just a ticker symbol. It's a claim, however imperfect, on real assets and real operations. Factories, equipment, inventory, land, distribution, customers, and sometimes exports. In some crisis countries, equity markets have posted enormous percentage gains in local currency terms. On paper, it can look like stocks are booming. But often what's really happening is simpler. The currency is losing value so fast that everything priced in that currency explodes upward. If the exchange rate changes from 10 units per dollar to 30 units per dollar, the local currency price of the same underlying asset often triples, even if the business didn't become more productive overnight. The nominal price rises because the measuring stick is shrinking. However, and this is the part that matters, not all stocks are equal in a collapse. Businesses that depend entirely on local customers paying in a collapsing currency can struggle badly, even if their stock price rises nominally. Their input costs can jump, imports become expensive, and real profitability can get crushed. But companies with export revenue or revenue tied to foreign currencies can behave very differently. If a firm sells internationally and receives dollars or other stable currencies while paying many local costs in the weakening domestic currency, its real margins can actually improve. That export capability becomes a shock absorber. This shows up in multiple historical studies of currency crises. When local currencies devalued, businesses able to redirect output to export markets often held up better and sometimes benefited relative to businesses trapped in purely domestic demand. So the real takeaway is not stocks always save you. It's this. In currency crises, productive companies with hard currency revenue streams can be among the more resilient assets, sometimes even inflation hedges, while domestic-only businesses can deteriorate alongside the currency. And that brings us to the core framework for this entire video. In collapse scenarios, the winners aren't always the assets people call safe during normal times. The winners are often the assets that are hardest to debase, hardest to trap, and most connected to real-world scarcity or hard currency cash flows. This channel is about financial forensics. I don't do motivational speeches, I do autopsies. I lay out what happened, why it happened, and what the patterns look like before they show up again. No paywall, no expensive masterclass, just the receipts. Now back to the list, the assets that tend to survive when money stops working. 4. Consumables and barter goods. When a formal currency collapses hard enough, people don't stop trading. They just switch the medium of exchange. After World War II, for example, Germany's old currency became so distrusted that everyday exchange migrated to goods people actually wanted. You saw trading in basics, fuel, food staples, heating materials, and in one especially famous case, cigarettes. Cigarettes worked as a stopgap money because they had properties you want in an exchange tool. They were standardized, divisible, portable, durable enough, and widely desired. They didn't require trust in a government or a central bank. They required only one thing, people agreeing they were useful. And you can see the economics of this in real time. In places like prisoner of war camps, shipments of aid packages sometimes introduced huge quantities of cigarettes into a closed community. When that happened, prices in cigarette money rose. because more units of the exchange item chased the same limited goods. The mechanism wasn't mystical. When it was the same supply and demand dynamic you see with any monetary system. More money relative to goods means higher prices. Fast forward to modern collapses, and the logic repeats. In Venezuela, as the local currency lost functionality, barter and quasi-barter became common in daily survival. Food for flour, labor for medicine, supplies for transport. In severe shortages, what held value wasn't financial, it was immediately useful. Medicine and basic medical supplies, food and clean water, fuel and means of charging/lighting, batteries, lighters, etc. Hygiene essentials that reduce illness and keep daily life stable. Basic tools and repair items that keep households functioning. But here's the key limitation. Consumables are powerful in the acute phase precisely because they get used. That also means they're not ideal long-term stores of wealth. You can't build a lifetime financial plan around bandages and batteries. The practical way to think about them is tactical liquidity, a small allocation meant to bridge periods when payment systems freeze, shelves empty, or access to banking becomes unreliable. Useful during disruption, but not a wealth engine. 5. Agricultural land. If there's one real asset that doesn't depend on financial confidence, it's land that can reliably produce the one thing humans can't opt out of: food. In the Great Depression, rural households often had a stark advantage over urban households because they could produce calories directly: gardens, orchards, livestock, preserved foods. They could cut back on non-essentials, but they weren't starting from zero when supply chains tightened. The same principle shows up in modern collapses. If currency is melting and prices are breaking, land that can produce food still produces food. Urban commercial property, on the other hand, depends on tenants paying rent in a unit of account that may be losing meaning by the week. Calories tend to win. But agricultural land comes with serious vulnerabilities that people romanticize away. First, illiquidity. You can't move it. You can't quickly sell it without taking a hit, especially in a crisis when buyers disappear or financing dries up. Second, political risk. Governments know exactly where land is. They can regulate it, tax it, restrict it, or in extreme cases, seize it. Zimbabwe is a stark example of what rule changes can do. Property rights were altered by decree, high-functioning farms were disrupted, output fell sharply, and land values were crushed in a short window. Land that was real value became real vulnerability under a hostile policy environment. Third, taxation pressure. In many crises, the state becomes desperate for revenue. Land can be targeted because it's visible and immobile. Owners can be forced to liquidate at bad prices just to meet taxes and fees. Fourth, what the land produces matters. Land that supports crops tied to export markets can be more resilient than land that only sells into domestic markets. Export-linked production can generate harder currency revenue. Domestic-only output gets paid in the collapsing unit. So the realistic conclusion is not everyone should buy farmland. It's that agricultural land can preserve fundamental value through production, but it is generally less portable, less liquid, and more exposed to government intervention than assets like precious metals or ownership in globally connected businesses. Now, what tends to go to zero? Knowing what survives matters, but knowing what gets destroyed is just as important because the fastest losses usually come from assets people assume are safe. 1. Fixed income claims, denominated in the failing currency. Bonds, treasury notes, and most creditor assets in the collapsing currency are structurally vulnerable. If you're holding a government bond and the government repays you in a unit that has lost most of its purchasing power, your repayment can still be a wipeout in real terms. Weimar-era domestic bondholders learned this the hard way. The payments arrived, but the currency used to pay them had been hollowed out. Argentina's debt crises showed another version, restructurings that reduced nominal values dramatically, paired with long delays and years of legal uncertainty. The underlying issue is simple. A domestic currency bond is ultimately a claim on the domestic currency. If that currency breaks, the claim breaks with it. 2. Domestic currency bank deposits inside a failing banking system. This is the quiet killer. People often think, at least bank deposits are stable, at least the number doesn't move. In a currency breakdown, that stability is an illusion. The number may remain the same, but what the number can buy collapses. Lebanon is a clean example. Depositors saw their local currency purchasing power deteriorate massively as exchange rates shifted, and access restrictions compounded the damage. In many banking crises, the failure isn't just devaluation, it's being trapped. Withdrawal limits, conversion rules, delays, multi-rate systems, and temporary measures that last for years. When the state and banking system are both stressed, being a creditor, whether through bonds or deposits, can be the shortest path to severe real losses. Where are warning signs showing up? Pattern recognition only matters if you can spot the setup. In fragile systems, you often see the same early behaviors: cash shortages and withdrawal limits, a signal of trust problems and liquidity stress, multiple exchange rates, official versus street reality, currency smuggling and informal dollar pricing, rapid migration into gold or alternative stores of value, rising reliance on barter or goods-based exchange in pockets of the economy. You can observe versions of these dynamics in various countries at different times, some in early stages, some already deep into the cycle. And then there's the big discussion everyone dances around. Major reserve currency countries, large debts, rising interest burdens, and shifts in global reserve composition don't automatically equal collapse, but they are part of the historical conversation because reserve status is not permanent. History has enough examples of dominant currencies losing ground over time to make complacency a risk by itself. The point isn't to predict a specific date. The point is to understand that the concept of could never happen has a terrible track record. The real takeaway: currency breakdown isn't a fantasy scenario. It's common in the long arc of history. But the practical question isn't, will anything ever go wrong? The question is, if the monetary environment shifts sharply, do you have a portfolio that depends on one single system, one single currency, one single jurisdiction? If you study enough case histories, you keep seeing 5 categories that tend to be more resilient than people expect. Precious metals as a long-run store of value anchor. Foreign hard currencies as an escape valve during local failure. Productive equities, especially businesses with hard currency revenues or export exposure. Consumables/barter goods as tactical resilience during short disruptions. Agricultural land as fundamental value through food production, while respecting its political and liquidity risks. And you keep seeing 2 categories that get hit hardest. Domestic currency fixed income, credit claims on a failing unit. Domestic currency deposits trapped inside stressed banking systems. This doesn't mean you abandon your home country. It doesn't mean you live like a bunker prepper. It means you treat diversification as more than owning 5 tickers that all depend on the same currency regime. The calm, rational goal is simple. Build a structure where no single failure mode can wipe out your purchasing power. History already ran the experiment. We're just reading the results. If this gave you a clearer lens, subscribe. Leave a comment with the word forensics if you want more breakdowns like this. And remember, the people who get hurt the most aren't the ones who are wrong about the future. They're the ones who never planned for uncertainty at all. Thanks for watching.